Capital gains deferral. Capital gains deferral allows a taxpayer to postpone paying tax on profits from an investment until the asset is actually sold and the gain becomes real in the eyes of the tax authority. The idea has been part of tax systems for decades, especially in countries that want to encourage long-term investing rather than rapid trading. If an investor holds a stock, a piece of land, or a business interest that rises in value, no tax is owed while the gain exists only on paper. The tax bill appears only when the asset is converted into cash. What makes this approach different from other rules is the simple timing element. The profit exists, but the tax is delayed, sometimes for many years. That delay can be extremely valuable because the money that would have gone to taxes can continue to grow and generate additional returns during the waiting period. Depreciation. Depreciation allows businesses and property owners to gradually deduct the cost of an asset over time instead of all at once. The concept dates back to the early industrial era, when governments recognized that machinery, buildings, and equipment wear out as they are used. Rather than treating those purchases as permanent expenses, tax law treats them as assets that slowly lose value. Each year, a portion of that value is deducted from income, reducing the tax owed. What makes depreciation stand out is that the deduction often continues even when the asset is still producing income. In real estate, for example, a building may rise in market value while still being depreciated on paper. That mismatch between accounting value and market value creates a legal gap that reduces taxable income without reducing actual cash flow. Offshore tax residency. Offshore tax residency allows individuals or companies to establish legal residence in a country with lower tax rates, even while maintaining business or personal connections elsewhere. This practice became more common in the late 20th century, as travel and global banking made cross-border living easier. The key factor is not secrecy but residency rules. Many jurisdictions tax residents on worldwide income, while non-residents are taxed only on income earned within the country. By meeting specific legal requirements, such as spending a minimum number of days abroad or maintaining a primary home in another nation, a taxpayer can shift their tax obligations. What makes this strategy significant is that it relies entirely on geography and legal definitions rather than hidden transactions. Governments often tolerate it because it encourages investment and economic activity within their borders. Loss carry-forward. Loss carry-forward allows a taxpayer to use past financial losses to offset future profits, reducing taxes in later years. The rule emerged as a way to stabilize businesses that experience uneven income cycles, such as startups or industries affected by economic swings. Instead of being punished for a bad year, a company can store that loss and apply it when revenue improves. When profits eventually arrive, the earlier losses are subtracted before taxes are calculated. What makes this mechanism different from other deductions is its ability to move across time. The loss does not disappear at the end of the year. It remains on record, sometimes for many years, waiting to be used. For growing businesses, this can mean surviving early setbacks without facing a heavy tax burden the moment success begins. Like-kind exchange. Like-kind exchange allows an investor to sell one property and purchase another similar property, without immediately paying tax on the gain from the sale. The rule has roots in early property law, when lawmakers wanted to make it easier for farmers and landowners to trade land without losing capital to taxes during routine exchanges. Instead of treating the transaction as a final sale, the tax system views it as a continuation of the original investment. The gain is not erased, but it is postponed until the new property is eventually sold for cash. What makes this provision especially powerful is its ability to be repeated. Investors can move from one property to another over many years, steadily upgrading assets while keeping their capital fully invested. Tax credits. Tax credits directly reduce the amount of tax owed rather than reducing taxable income, which makes them one of the most straightforward and powerful tools in the tax system. The idea developed as governments searched for precise ways to influence behavior without rewriting the entire tax code. Instead of lowering taxes across the board, lawmakers could reward specific actions, such as investing in research, installing solar panels, paying for childcare, or pursuing higher education. Unlike deductions, which depend heavily on income levels and tax brackets, a credit usually subtracts the same amount from the final tax bill for everyone who qualifies. In some situations, the credit can even exceed the tax owed, resulting in a payment from the government to the taxpayer. What makes tax credits especially valuable is their predictability. A business owner or investor can plan around them with confidence, knowing exactly how much tax relief will be received once the qualifying activity takes place. Over time, entire industries have grown around certain credits, particularly in technology, renewable energy, and housing, because the financial incentive is clear and reliable. Income splitting. Income splitting allows families or business partners to distribute earnings among multiple people so that each person pays tax at a lower rate under a progressive tax system. The concept gained attention as governments introduced higher marginal tax rates on top earners, creating a noticeable gap between what high-income individuals paid and what lower-income individuals paid. By legally sharing income with a spouse, adult child, or business partner who falls into a lower tax bracket, the total tax paid by the household or partnership can be reduced without changing the overall income generated. In family-owned businesses, this often takes the form of paying reasonable salaries to relatives who genuinely contribute to operations. What makes income splitting stand out is its reliance on structure rather than secrecy. The income is still reported, documented, and taxed, but it is spread across several taxpayers instead of concentrated in one. Governments frequently adjust the rules to prevent artificial arrangements, yet legitimate income splitting remains common because it reflects the reality that many businesses and households operate as teams rather than individuals. Retirement account sheltering. Retirement account sheltering allows individuals to place money into specially designated savings accounts where taxes are delayed, reduced, or sometimes eliminated entirely until the funds are withdrawn later in life. This approach became central to modern financial planning in the second half of the 20th century, when longer life expectancy made retirement funding a national concern. Governments realized that encouraging citizens to save privately would reduce pressure on public pension systems, so they created accounts with strong tax advantages. Contributions are often deducted from current income, lowering the tax bill immediately, while the investments inside the account grow without being taxed each year. Instead of losing a portion of gains annually, the full balance compounds over decades. When the money is eventually withdrawn, taxes are applied based on the rules in place at that time, often during retirement when income is lower and tax rates may be more favorable. What makes this mechanism particularly powerful is the effect of time. Even modest contributions can grow into substantial sums when taxes are deferred for 20 or 30 years, turning a simple savings plan into a major financial shield. Transfer pricing. Transfer pricing allows multinational companies to set prices for goods, services, or intellectual property exchanged between their own subsidiaries in different countries, and those internal prices determine where profits appear for tax purposes. The practice developed naturally as corporations expanded across borders and began operating as networks of related entities rather than single businesses. When one branch manufactures a product and another branch sells it, the company must assign a price to that internal transaction. That price affects how much profit is recorded in each country. By carefully structuring those prices within legal guidelines, companies can direct a larger share of profits to jurisdictions with lower tax rates while leaving higher cost operations in regions with higher taxes. What makes transfer pricing distinctive is its technical nature. It is governed by detailed international standards that require transactions to resemble what unrelated companies would charge each other. Even so, there is often a range of acceptable values rather than a single correct number. That flexibility creates room for strategic planning, especially for companies that operate in dozens of markets at once. Charitable contribution deductions. Charitable contribution deductions allow taxpayers to subtract the value of donations made to approved nonprofit organizations from their taxable income, effectively lowering the amount of tax they owe while supporting social causes. The rule became widespread in the early 20th century, particularly during times of economic hardship and war, when governments relied heavily on private charities to provide education, healthcare, and community services. When an individual or company gives money, property, or other valuable resources to a qualified organization, the tax system recognizes that contribution as a public benefit and rewards it with a deduction. In some cases, donors can also deduct the fair market value of assets such as stocks or real estate, which can be especially advantageous if those assets have increased in value over time. What makes this deduction unique is the way it blends financial planning with social responsibility. Large donations can significantly reduce a tax bill in a single year, yet the funds still serve a broader purpose in society. For wealthy individuals and corporations, philanthropy often becomes part of a long-term tax strategy, shaping both their public image and their financial outcomes.